Welcome back, traders and investors, to Benzinga's pre-market prep, brought to you by MarketFi. We have tracked down Sean Emory. He's a portfolio manager and author of the MarketMeter.com. Sean, how you doing on this Thursday morning?
I'm doing well. How you guys doing?
Good, good. You got big plans for the 4th of July weekend?
I'm taking a trip down south to Key West, so that's my plan. How about yourself?
No, just sticking around here, doing some swimming, maybe a little golfing for sure, a lot of barbecuing. Just want to touch base with you here, just talk a little bit about the broad market here. Really not much fireworks off the unemployment number. We did have some fireworks with Greece here, kind of a topsy-turvy week. Still in the trading range here, or is there a little chink in the armor in the market?
So I'd say I am getting a little nervous. So short term, I'm really not buying this market broadly, and I don't mean that statement really fundamentally. I think the markets fundamentally still are relatively attractive, but I pay attention to the technicals, and when I look, I simply see too many red flags that I can't ignore. If you look at things like seasonality, third quarter tends to be one of the weaker ones. Market breadth, therefore looking at the amount of stocks above their 50 and 200-day moving averages, making lower highs. RSI, MACD indicators remain weak. The Dow Transport, high yield, all those things continue to be weak. And really one thing that I've actually been looking at is the 10 and 12-month moving averages for small caps and the S&P 500. And at the end of the day, these are really longer-term trend lines. And when they start to roll over, that really means that obviously the trend is beginning to roll over. And I like to at least acknowledge these things, that they do exist, and I'm paying attention. And when I'm looking at individual names today, I'm actually having trouble finding companies that have strong technicals and things that I want to own fundamentally. And that same kind of idea is showing up in the broader market. So today I'm still sourcing, looking for these ideas where I can play fundamentally and technically, get them both to align, and make those returns that I expect.
Okay, well, you got over $1 billion in management here, so you just can't just like get out of the market, right? Because the unexpected returns, if you're falling behind the benchmark. So do you try, like in this, you got a little technical malaise here. Do you try and lighten up a little bit? Do you try and implement some hedging strategies, or you just say, hey, this is a little short term. I'm gonna have to stomach this, but my long term thesis is still riding the bull. What do you change your strategies or your asset allocation at all?
Yeah, so predominantly fundamentally driven, more long-term focused. We do pay attention to the shorter term, so we start to take off our weaker stuff, our weaker positions.
Nice.
Maybe things that were related to the energy sector, trimming those a little bit, adding some hedges, maybe adding some things such as some bonds that will allow us to be a natural hedge, that natural insurance if things actually go sour and kind of grease this weekend.
All right, so last time you were on, was it the actual day that Coors was just getting the beats, or was it the day after? I remember we had you on the show, and you said, hey, I'm looking at this. I'm not hopping in right now. You do like the fundamentals on it. Have you stuck your toe in the water yet, or what are you looking for?
Yeah, so Coors has gotten beat up quite a bit. It was just after I spoke with you. It got beat up, I think, a month before that as well, or 2 months before that. So that's really where we started to get our interest peak, saying, this is a good company. So Coors remains an interesting idea to me. Last time we did speak about it, I got into the fundamentals a little bit, large cash balance, trading at a huge discount to the market, to itself, and has something that's really costly to replicate. It's a global brand that everybody knows. So I've been waiting for the technical picture to improve, like you were saying. It really hasn't, and that's been the smart move so far. But this week I actually started to nibble in a more interesting way. Earnings is coming up on August 4th. The market is expecting some volatility, obviously, going into the move. And I wanted to take advantage of this story because I like it fundamentally. So what I did was actually go out. I sold the August 7th put purposely to be just after earnings to really capture that premium. I bought it for about $1, strike price at 39. So ultimately, I collect $1. You multiply it's 100 shares per contract. So that's really a 2.6% yield for that 1 month time frame. You can annualize it and say it's a 30% annual yield, but really 2.6 for the month. And really, in summary, it's really, I want to own cores. I've wanted to own it since we spoke last time, but until I start seeing that bottom start to form, I don't want to get involved. But here, I'm seeing a price where it's trading at 9 times forward earnings. If we do get down to my break even, which would be 38 in this case, that's an 11% drop. You're talking about an 8% forward earnings on a huge global brand. And that 38 level happens to be 2012 support just after IPO, which for me that seems interesting. So I wanted to take advantage and hold a position, a bullish type of position, but still in a kind of capital preservation type of manner.
And it kind of defensive too. I mean, you don't mind owning it at 38, right? And that way, if the stock doesn't necessarily need a big rally for you to cash in. That's a great strategy that's employed by Nick Shaheen, who we have on Tuesdays. It's just use it. You just don't have to go out and buy a stock, at a certain level and just take on the risk. So great. We only have about 4 minutes left here, so I just briefly want to talk about some other stocks on your radar or ETFs. First thing, just give us a quick look at Boeing, BA.
Yeah, so Boeing's taken a lot of heat lately. They went out to the Paris show. Airbus came out at the last second with some stated deals, the contracts that were potentially in place. Boeing was winning the contract race the whole show. And literally at the last hour, Airbus came out, and that hit the stock even more. Boeing is an interesting story fundamentally for us. Huge company. They have a huge backlog that dates back 15 years, 10 years, where you really can see the trajectory of cash flow for this business. There's a huge thematic story behind it in terms of growth of plane count throughout the emerging markets, through Asia. Boeing is really going to take advantage of this. But Boeing is a huge business. They pay a dividend. We have owned it for a while, but we're looking to add to this position. It's made a series of higher or lower highs over the course of several months now. But we think at these levels, it's hopefully starting to form a bottom where we would get interested again and increase the position here. If we can break out above these lower highs, the downtrend, that's when we would get active once again and get into a fundamentally good story where technicals are starting to line up.
Yeah, I think I read in Barron's last week that they have revenue and projects booked for the next 5 years. And, pretty impressive for a big company like that. Alibaba, I did step my toe in that earlier in the week and came out alive. I'd been waiting for that gap fill, and I don't know if it exactly got there. I think I might have still missed it by a couple ticks, but hey, who wants to wait for the exact gap fill? It did. Let's see. On the earnings day, you gapped up from 80.85. A few days ago, you came back down to 80.80. So it was an exact gap fill. I did get that right. Getting a pop here, but just not really shooting out of here. What's your take here on Alibaba?
Yes, I look at it two ways. The story is great. The story is great in my view. I tried actually playing it after the gap up post earnings and using that gap up as my stop loss. It was working for the time being as we moved up to the 94 level. Looked like we were going to fill this gap and hopefully move higher. Unfortunately, what you saw was it completely collapsed, kind of hit some sort of trend line from the peak and moved back lower pretty quickly. We got stopped out with a minimal loss, but stopped out and we abided by our stop loss. One key issue or fundamental about it that seems to be potentially an issue, especially for the institutional type of investors, is in September, a huge lockup comes due from the IPO, where a lot of money is going to be eligible to sell. And I think that's one of the things that's keeping some of these institutional money on the sidelines for now. But everyone on the street seems to like the business, the company, and what they're doing. So it's a great story. It's something that hopefully here at the 80 level, with like a 78% stop or $70 target stop, where I'd probably start to get interested again and nibble back in. But great story, and again, I want the technicals to start heading back more positively so I can get active again.
Sean Emory, portfolio manager and the author of themarketmeter.com. Thank you, Sean, for joining us, and we'll talk to you again soon.
All righty. Have a good weekend, everybody.
Yep. Thank you.